Brown Show, where we talk about all things investing, options trading, and the like. Now, here's your host, AJ, whose primary mission in life is to help you become a better investor.
All right, ladies and gentlemen, welcome back to the AJ Brown Show. My name is Cyprian Francis, and with me, as always, the main man of the hour, Mr. AJ Brown. How are you doing today, AJ?
I'm doing awesome. We've been having some amazing weather here on the East Coast, so I couldn't complain.
That's right, amazing weather and some movements in the market. I know we were just talking before the show about how summer is usually very
Boring.
slow, very boring. But I saw a stat this week that the move, not yesterday, but maybe the day before, was like one of the biggest to the downside that we've had in 2 years in a July. What's going on, AJ? What's driving the market?
Well, so here in the trading world, we have this phrase that I don't know how many years I've heard of this phrase, but it's that the bull climbs up the stairs and the bear jumps out the window. And we're witnessing the bear jumping out the window, Sip.
And is there a specific catalyst to this? I believe last week we covered earnings. Was there some indication that things are slowing down on the corporate side?
I mean, yeah. So, first of all, we have been talking about on this show how there's been this divergence. Just like you mentioned that this is a record July for the downturn, the sell off in the last couple of days. We also have had a record in the divergence between, how much money has been going into symbols like 3 or 4 of the Magnificent Seven versus the rest of the S&P 500, right? If you look at my chart, this is the S&P 500 and this is the S&P 500 equal weighting, where this index shows if we were to take each one of the 500 stocks and give it an equal share of the index rather than having them weighted by how big their market cap is. And so what you see here is that most of the stocks have been in a sideways move, but then when you start to look at something that's weighted by the size of the company, what this shows is that a lot of money has been flowing into just a few names. And it just got to be the point where those names started to get bloated, right? And we got reports from Google this week. And yeah, they did better than their guidance, but they said a few things during their call, like, for instance, that ad revenues, their core business, what's been fueling them for decades, their ad revenues, especially on YouTube, are down, right? And so that worries investors who want to make sure that they're going to get their money back. And then what they also hinted at is that AI is going to take more investment and more time. It's not going to satisfy investors' instant gratification the way that investors expected it to. It's going to take more time and more money to get it right and to get it to be monetized. And so that freaked people out. Add to that Tesla really missed their guidance big time. And you started to see a lot of money flowing out of these big names and going into defensive places in the markets and investing in general.
Yeah, and those are Google and Tesla are two of those biggest big names that have been moving. And I actually saw a complimentary chart. This guy, Charlie Bilello, is great on Twitter. But in the last 10 days alone, small caps up 7%, large caps down 4%. We're closing that gap. Anything else you believe might be driving this? I know we got some pretty impactful economic data today. We had some GDP numbers this week, some home sales. What of all that do you think is potentially fueling this pullback? Because we've been wanting this pullback for quite some time. We're finally getting it, and we could revisit that. But on the economic front, anything there catching your attention?
Well, it doesn't. First of all, yeah. So let's talk about home sales, because we got existing home sales on Tuesday. We got new home sales on Wednesday. Same old picture. First of all, interest rates are high, so people are hesitant to do any sort of buying right now because they perceive interest rates will lower, and it's just expensive to borrow money to buy something as big as a house. And at the same time, the supply here in the States is still crunched, so home prices are still very high. So people who may be potential buyers in the future want to make sure they're getting as much house as possible and giving as little money to the banks. They'd rather reduce their monthly or keep their monthly the same but get more house for it rather than have to spend those carrying costs. So that's the story on home. That hasn't really changed. We got GDP on Thursday. So remember, GDP is reported 3 times. They give you the advanced numbers, then they come back a month later, they give you the preliminary numbers, and then they give you the final numbers. So if we dissect this a little bit, this is for Q2, and this is the first pass. This is the advanced numbers, right? So quarter over quarter, 2.8% growth. So that's hotter than it was in Q1. Q1, we ended up at 1.4%. So Q2, we've seen some growth in and it was way better than expected, right? And the PCE, this is, a first pass at the personal consumption expenditures, also higher than expected and higher than last quarter. So that concerned investors because that gives the Federal Reserve Bank more reason to stay the course and not lower rates. But then today, we got our PCE. Now, this is reported to be one of the top reports that the Fed actually uses. I'm going to load up my magic marker so I can do some screen annotations. But while that's loading, first of all, personal incomes is down. Second of all, consumer expenditures is down and at expectations all across the board until we get to these core numbers. So this is where you factor out everything that's volatile and you're left with, inflation on those core items. And it's still running a little bit warm. So I see that the market's recovering a little bit today, although it looks like it's already off of today's highs and it's not really recovering with quite vigor. I almost feel like today is another one of those attempts at bargain buying like we saw about 4 or 5 days ago. And I'm not sure, Sip, how much traction we're going to get with today's bargain buying because the news really hasn't changed. That economic news that we just looked at was neither positive nor negative, right?
Yeah, we keep getting like good news, bad news, good news, bad news. It's kind of in the middle. And, I think the market's trying to predict when this next rate cut. Everyone's just waiting for a rate cut, but the data is kind of showing us that I don't really need a rate cut just yet. I mean, inflation's high, growth is there.
I got to point something out with
right?
with respect to the whole rate cut. The market has been very interesting in what they're pricing in. So, of course, this meeting next week, it's almost unanimous. I mean, that hasn't changed. We don't expect any sort of rate drop next week. But then September, interestingly enough, this number has kind of cooled off a bit. This is for the first rate hike, but not cooled off drastically. But last week, it was up around 92% of investors polled expected a rate drop, and they're pricing that into their investing strategies. Now it's down at about 87%. But that is not, that's still compelling that there will probably be a rate drop in September. But interesting is the November and December picture has really changed from last week. The November number for a second rate drop is actually way higher than last week. So they're expecting a second rate drop in November, not waiting until December. In fact, the December now outlook is that there'll be a third rate drop, and that got stronger in investment belief as well. So last week we were kind of, flirting with the idea of pricing in 3 rate hikes. Today, a week later, it's that much more solid.
Oh, looks like I lost AJ there for a moment. Not sure what happened. I heard some beeping taking place. Let's go ahead, take him off screen. All right. I'm gonna go ahead and pop in the background to see if oh, there he is. Oh, got you kicked off there, AJ. Oh, oh, microphone's on. Oh, looks like we got to reset. We can't hear you, AJ, so we're gonna have to wait for your microphone to load up. So let me take you off camera here for a moment. All right. As AJ's going and getting his setup back, I do want to give everyone an opportunity to check out AJ's daily workshop. So, this is episode 143. We've been doing weekly episodes on how to use options to advance your investment portfolio. He's got an awesome daily workshop. We're going to go through some examples later on in the show. If you need or if you want a specific overview from AJ, feel free to throw it in the chat and we'll see if we can get it on the show. Otherwise, yeah, this market pullback is a great opportunity to start utilizing the power of premium selling, options trading. So if you haven't added that investment tool to your portfolio, it's a perfect time. So once again, the link to that is in the chat. Let's go ahead and see if we can get AJ back into the fold. AJ.
Hey, okay.
Hey, I heard a beeping and then we went out. So
I have no idea what's going on here at the studio, except for I heard the backup power kick in, which doesn't make sense because it's not storming outside. So I don't know why the backup generator kicked in, but I'll worry about that after the show's over. But yeah, we had a little transfer and my office just does not like it when that happens.
CrowdStrike. I'm going to go ahead and blame that one for CrowdStrike. We talked about that last week. And I just want your thoughts on if you were a CrowdStrike customer and then you like log into the portal or whatnot and you get a prompt that they apologize and in return they're going to give you a $10 Uber Eats certificate. What would you think of that?
CrowdStrike, I fear for them that they are very much going to go bankrupt very quickly. You can't take down the world like that. With a upgrade, definitely people are going to get fired. But if I was a customer of theirs, which thankfully I'm not, if I was a customer of theirs, I would not be a customer anymore.
And Delta's, I think, still dealing with it. Like I think Delta got hit the hardest. Like people were stranded for like 4 or 5 days, and
yeah.
This has nothing to do with weather, right? So that's even more astonishing.
Yeah. Yeah, it's insane.
All right. Well, we had a bit of a detour there. I do see in my notes that you did mention that Visa and American Express also had some earnings, and they're reporting that lower income consumers are starting to spend less. So that's a sign of slowdown, correct?
Slowdown. Yeah, Visa and American Express reported that lower consumers are not charging anymore. And then throughout another thing that's hinting at consumer discretionary spending starting to dwindle is a lot of food companies that supply restaurants, and a lot of the big restaurant chains, they're no longer being as rosy as before. They're missing earnings because it looks like folks are starting to save their dollars and not go out and eat even as much as they did last month. I don't think it's a weather thing, folks. I think that people are starting to tighten up their purse strings. So that's slowdown. And this all contributes to the bear jumping out the window, right? And that's what we've been seeing, is that the bear has been wanting to jump out the window. just to give people a little bit of background on that phrase, the markets, the equity markets have always been considered a more risky investment. So what folks do is they take a little bit of money from their safe investments and they dabble in the market slowly but surely until they can build confidence. So when you see the market go up, it goes up cautiously, it goes up trepidatiously. It's the bull climbing the stairs. But the opposite is true when there's any signs of pullback in a risky market. When all of a sudden it seems like your money is not safe, people will not cautiously and trepidatiously remove it from the markets. They take it all out at once. In fact, my program participants, I can think of the names of some program participants. We've been doing our program since 2003, and there are some names that are popping into my head. There have been folks who have taken our program who, before learning how to invest in the markets, their safest investment was either putting their money into their mattress, actually sewing a zipper into the side of their mattress, or literally burying it in jars in the backyard. So, you think about that and you think about these people are pulling their money from the markets and putting it back into their mattress, putting it back into the jars, the bell jars that are buried in the backyard. One other thing that I have often added is that the bull climbs up the stairs, the bear jumps out the window, and the bears hit the floor quickly. So what we also see is that when the market is done selling off, that buying comes in a rush. So the bottom is going to be an interesting place to find.
And we can kind of touch on the potential of what maybe some of those bottoms look like, because I know you have some pretty sophisticated Fibonacci retracements. You got your little range zone, your color zones.
Yep.
So we could potentially cover that when we discuss our topic of the week, our trending topic. So let's go ahead and take a break. We'll be back. We'll talk about that. We'll let the users, if anyone has a specific ticker name that you want AJ to run through, feel free to throw it in the chat. We're going to take a break. We'll be right back to talk about premium selling. How, we're finally getting a pullback. Can we make some money off of it? And the answer is yes. And we're going to show you how. So stay tuned, folks.
You're afraid of trading in the markets. Guess what? I've got your answer. I've got 4 strategies I'm going to give you along with the tools to make it super easy. I'm going right home, giving you the webinar. I need you to sign up below and meet me in a few minutes.
All right. I'm liking today's trending topic. I think this is a question that a lot of investors and or traders, new investors, even old investors struggle with. And that's when you feel like a position is going to, you put on an investment because you think a certain thing, because the stock's going to go up, it's going to hit a certain point. But when you're wrong, that's the hardest part, I think, of being a trader, is when you're wrong, is admitting you're wrong and then coming up with the next steps, the next plan. And so, in this specific instance, let's talk about how to pivot when the market changes, specifically when utilizing premium selling trades. So
absolutely,
let's dig into that.
Okay, so one of the candidates that we looked at yesterday yesterday we had a really unique thing, Sip, and we do this about once a month, maybe once every 2 months, at our workshop. And then I'm kind of giving you guys an insight into what we do when you are part of our program. At our weekly workshop, we usually are taking a crowdsourced candidate, taking many crowdsourced candidates. We're analyzing them and we're picking the one that has the highest probability for profit. And then we're taking that one and as a group, we're planning it out so that we all have a very detailed trade plan that we can then execute over the next days. Once in a while, about once a week, or once a month or once every 2 months, what we do is we do a hot seat. We bring in one of our program participants that's done a trade, and we go over how they saw the different signals and how they executed. So last night we had a hot seat on ticker Allegro Microsystems, ticker ALGM, and I have that up on the screen. And so here's the long story made short. Your option trading strategy is matched to whatever you're seeing in the markets, whatever patterns that you have recognized, whether they be patterns in price, whether they be patterns in implied volatility, whether they be patterns in time passing by. And so the scoop is number one, being aware when that pattern changes. And that has been the demise of many a trader, right? A lot of traders stick to their guns, either consciously or a lot of times subconsciously. They stick to their trading strategy that is really best suited for a particular pattern. And when the pattern changes, they decide to stay with that strategy. And they may not know that, right? Because a lot of people will take like an options trading course. Some of the most popular courses out there are courses on vertical spreads, vertical credit spreads, vertical debit spreads. These are spreads where you're doing 2 options simultaneously. They have the same expiration date, different strike prices. And you'll take one of these courses. I know, because I sign up for all of them, because I'm always curious about what other people are offering for educational courses out there. And without a lot of education on what a vertical spread is and how it works, these people who offer these courses just give you like a screener that they run behind the scenes and say, here's a stock you should write a vertical spread against. And so maybe at the time that the screener finds this candidate, the person could write the vertical spread and have a good probability of making a profit. But if something like what happens in the market over the last, 5 trading days happens, and all of the candidates, whether they be screened or not, follow suit, correlation is really a thing these days, thanks to exchange traded funds and such. If all of your candidates pull back, some people who don't have the understanding of what's going on, they'll stay in that vertical spread, right? Because they don't know what to do. They've never been taught what to do. They were just told to apply a vertical spread to a screener candidate, right? But the key is you need to be able to understand when the pattern changes and how to adjust your trade such that it takes advantage of the new pattern, and you don't, either consciously or subconsciously stick in a strategy that doesn't work with that pattern. I have seen, if I have been given even, a dime for every time somebody has approached me and said, hey, I was trading vertical spreads with XYZ course, they would give me a candidate. I would apply the vertical spread. And for the first 9 months, I was doing really well. I was making, 5, 6, 7, even sometimes 10, 11, 12% every month on my trades. But then something happened in month 9. I'm not sure what happened, but all of a sudden my vertical spread worked against me, and I gave back all the profits from the first 8 months. Plus I lost half of my initial investment, half of my portfolio, and now my house is under mortgage and my wife wants to leave me. If I had a dime for every time I've heard that exact story, and it just comes with the fact that you need to be aware of what's happening in the market, and you need to be able to pivot tactically. This is what we teach. A premium trade, whether it be a vertical spread or how we leg into things like diagonal spreads or covered calls or covered puts, we know that those strategies are strategies we call range bound. That means that they're going to do their best if the underlying symbol stays in a range. Like you can see, Allegro Microsystems over the last 6 months has been really good at staying in this range between about $26.25 and $31.25, right? But the scoop is what we like to do is basically come out. We've identified this channel that we can trade our premium trade in, and we'll identify a boundary about 40% of the way of the channel outside in either direction, right? There's 40% there, 40% there. And that magic number of 40%, it's not something I just came up with out of my rear end, Sib. This is a number that statistically, if a stock that has been channeling bounces out more than 40% of its way out of a channel, the likelihood, the probability that it'll come back into the channel and even better, cross the channel, goes down drastically. It falls off of a cliff, which basically means if you go 40% out of the channel, it's likely not going to be range bound anymore. So you shouldn't be in your strategy anymore that's counting on the symbol being range bound. If you stay in it, you're just going to lose all your money. So you need to be able to pivot. Our hot seat guy, bringing the whole story back to what happened last night, he recognized that this underlying symbol was no longer in its range, right? And we even asked him, we said, well, hey, earnings is coming. What are you going to do about earnings? You know, when in doubt with any of these range bound strategies, if you're curious, you know, if you're concerned about earnings, you cash out. You let earnings come and go so that you don't get caught with your pants down. So we asked him about it, and he said, you know what? If it would have been any other time, I would have been comfortable weathering earnings, because this particular symbol tends to blow off earnings like, you know, it's no big thing. He's like, but the fact that we had this sell-off, and this is a company, Allegro Microsystems, that's related to the whole boom in chips, the whole AI play, you know, this is one of those companies wrapped up in that. He's like, since we're having that huge sell-off of companies like that right now, where people are now a little bit, you know, unsure of, you know, whether AI is going to be that big thing or not right now, whether it's going to produce instant gratification in the form of like profits. I don't think I want to weather earnings. So he was already looking for an exit of the position. But then the fact that it was flirting with this 40% line, he said, you know what? This is no longer a premium trade. I'm not going to continue to try to sell spreads or sell. In my case, he was going to be doing another leg of the diagonal debit spread, or actually he was doing a covered put. I'm not going to do another leg of the covered put. Instead, I'm going to look at how, you know, you would trade this directionally. And in the case of a covered put where you've got a shorted stock, he's like, it's time for me to take my money and run. And so he bought to close the stock, and he wound up with something like I think it was a 20% ROI in less than I think it was 6 or 7 weeks. You know, that's a great ROI in 6 or 7 weeks to make a 20% on your trade. And so it was the right decision. And the fact that he had been tuned in to pay attention to the patterns, and that's what all of our viewers need to do. You can't just apply a strategy willy-nilly. Even if somebody said, just take these, you know, if they tried to simplify the process and said, take my screener pick, apply the vertical spread, make money, and they don't tell you about the potential risks involved. You need to be able to identify when all of a sudden your pattern doesn't exist anymore, and you need to know how to pivot your strategy, how to adjust your strategy in order to make money. That's what we teach our program participants. And so I just urge everybody, that's the topic of the day, to be able to, you know, be aware of how to do that. Be aware of noticing when your pattern changes, and know how to pivot your option trading strategy.
And one of the easiest ways to kind of maybe forecast that is by having the right tool. And if you had AJ's free indicator here with the nice little red arrow,
Mhm.
you would have felt confident that that's the right side of the trade. And had once this blue arrow kicks in, that's another indicator that you
Mhm.
might be, it might be time to head out of there. So having the right tools and being willing to pivot. Thanks for that breakdown, AJ. Let's see if we can kind of go over a few more examples where we can discuss those types of movements, those types of pivots, and or find any new opportunities. So I'm
Mhm.
excited to talk about your pick of the week this week because it's a name that used to be a high flyer, like super high flyer, seems to have been under the radar for a while, for a couple of years maybe, and maybe starting to pick back up. And that's Alibaba, ticker symbol BABA. What are you seeing here, AJ?
Well, I like Alibaba. I like it as a symbol. I like it as a defensive play. This company has been around. It's basically the way that we can get things. They're the middleman for manufacturing in China and getting whatever you can put your mind to here manufactured there. They become the middleman. They take a lot of the risk away, and in return, they're a viable company. And you could see just in the last earnings, they are a viable company. They make money. They're even starting to give dividends to their investors. And the scoop is you're right. They've been under the radar, but they've been operating very well. I'm not necessarily, I want to do premium trading. I want to create income during this uncertain market, especially through the rest of this year and into the next year. Who knows what's going to happen? Just on an aside, in addition to some of the volatility here in the States, I mean, China just dropped a rate, did a rate drop on their central bank, which, they're the second biggest economy in the world right now, and they're worried about growth. France and Germany are all doing things. They're pretty big economies. Germany's a very big economy. Um, they're all talking about growth. So this is a global thing, a global slowdown. It's not just here in the States. In fact, a lot of investment, if you look at the bonds market, a lot of investment dollars just in the last 2 weeks have went from yen intensive investments to dollar intensive investments. So one of the good things for these US markets is that we are still the de facto defensive play. When people are afraid of what might happen in the world, their money comes into the US dollar as an investment, right? Because we're still considered, the most steady place to invest. So with all of that said, I'm okay that Alibaba is going sideways, and I'm okay looking at this company to create a income stream. If I go back in my charts and I look at the last year, I can see that around the end of fall, like the beginning of the winter, basically around October, November of last year, we started in this sideways channel. And I'm comfortable with that channel. That's where we've got support around maybe $70, $71, and resistance around $80. And now I'm going to zoom back into the more current time frame. This is the last 6 months. We got a signal. This is a signal off of my moving average crossings. We got a signal about a week ago. We got our follow through. I'm not sure. It could be that we come back for a double top. So I wanted to point out this symbol, especially for those folks with bigger portfolios like I do, because Alibaba has a very active options chain. There's people trading these options. There's a lot of open interest. There's a lot of daily volume. The bid-ask spread is small. you can invest a lot into the options chain. It's not one of these symbols where if you have any sort of a big portfolio, you might be being the only holder of the options. And so I wanted to highlight this one because this is a good place for folks to make money. I don't know whether or not we're going to get the next reversal is going to be a top or a bottom, but I put in my notes, Sip, the strategy for both. Maybe we can copy and paste that into the chat of the broadcast. But if we come up to a top, this would be a great opportunity for us to short some Alibaba and or buy a substitute put option. So either you're going to sell some stock or buy a substitute put option. If instead it continues on the downward slope that it's on, then if we bottom out at that $70 to $72 mark, then instead of shorting and buying put options, we want to go long and buy call options. It doesn't matter, right? Because this is a sideways channeling stock, and what we're trying to do is establish some sort of covering position so we can then start the cycle of selling premium. So in addition to this quarterly dividend, we'll be getting, cyclical payback every time we sell premium. And that's what I want to get my position. Alibaba is a great stock to do that. There's so many opportunities with where it's channeling. Now, if it's a little bit too expensive for some of our investors out there, and you want to basically, price in the amount of risk you can endure. But if it's too expensive, then you can always go the way of thinking about doing spreads on this. Spreads are a little bit cheaper, whether it be vertical or diagonal spreads. But if you go that route, again, make sure you only invest as much as the risk allows you to. So size your position accordingly. But Alibaba is a great underlying symbol, and it's in a great pattern.
And the breakdown of the specifics of that are in the chat. So
nice.
If you want to see, it's rather lengthy. So just, fair warning. But the details of that are available. So AJ's pick of the week, Alibaba, ticker symbol BABA. We got a couple of other names that are pretty popular, hot on the street and just hot in general. So let's dive into our speed round, and the first one is a name or a position that you've had success with over the past couple of weeks, and that's specifically the VIX. This is Sarah out of Brooklyn, New York. Wants to know, AJ, do we have a play in the VIX?
You did. You don't anymore. So let's review what our VIX trade is, right? Our VIX trade is based on the fact that the VIX is a measurement of confidence and fear. As the VIX goes down, that shows that investors are more confident about what is happening. And as the VIX goes up, it shows that investors are more fearful or confused or uncertain about what is going on. So you can see that confusion and uncertainty and fear has been the name of the game. We like to apply our VIX trade right when we get hints that uncertainty and confusion is coming. And if you download my free indicators, folks, that gives us a very good signal. You can see I've got a signal right here. This signal came to us, and these are end of day signals. We always like to get trading day follow through. So an end of day signal on July 8th, and it looks like we got our follow through on July 10th. That would have been the day, sometime July 10, 11, 12, to place that trade. At this point, you've missed the boat, right? It's because when we do this trade, we basically create one spread. Usually this is some sort of, either debit or credit spread. And it's a bull debit or credit spread. And then I'm actually going to turn off my disappearing ink here so it stays up there. We do a vertical spread that's a bull spread. It's usually a debit. And then we create a credit spread, which is also a bull credit spread that offsets the debit. So we actually try to get a tiny bit more credit than debit. So maybe as much as a nickel or a dime more credit than debit. So basically what that's saying is if the underlying symbol stays in this zone, you'll have a trade that basically breaks even, maybe gives you enough money in order to pay for your commissions, and you can walk away with a little bit of profit. The key here is when fear, right, and uncertainty take over and really draw people like it does, because when the bear jumps out the window, fear shoots up. Whenever we have these fearful moments like we're having right now, this trade starts going into this zone and pays us, like anywhere from 20 to 1 to 100 to 1, right? This is, this trade is considered a hedging trade, and it's when all the proverbial poop hits the fan, we walk away as winners. And you might ask, well, gosh, AJ, why don't we worry about this other scenario where, if all of a sudden there's an overwhelming amount of confidence and security in people's minds, why don't we worry about that? Because that looks like we would lose, 100 to 1, 20 to 1. And this is the psychology experiment on this. Humans don't get that confident. I mean, there's some confidence out there, but if you look at the history of the VIX, it never goes lower than a certain amount. We only get so confident, but when we are scared shitless, we get really scared to the point where we freak out. And that's the whole concept behind this trade. But to make this trade a winning trade, you really need to place it when you get the signal that all of a sudden there's impending fear. You can't place this trade. You can't chase this trade, right? In fact, I had a guru over, 20 years ago tell me that you place trades in times of peace, not in times of war. And what that meant was you place trades just when there's hints that there's going to be a disturbance in the force, rather than waiting for a full-on world war and then saying, I should place this trade, right? You don't want to be chasing a trade. You want to be one of those folks who picks up on the pattern. And that's why my indicators are so helpful, because they gave us a signal, over 2 weeks ago, and you see what's happened since. So for you, Sarah, in Brooklyn, New York, you did miss the boat, but at the same time, just wait, because this thing reloads. Like Sip said, we've traded this a couple times. The first time we traded, we got one of those payouts. The second time we traded it, it wound up breaking even on us, which is fine. Breaking even is fun. What we usually do is we put a portion of our portfolio into this type of trade. And the reason is because when this fear takes over in the market, a lot of our other trades tend to not do well, right? And what's nice about being a premium trader is we're less susceptible to that. But if you're doing a lot of directional trading, when fear takes over, a lot of our directional trades turn against us. And now you have a percentage of your portfolio that's going to pay back, and it basically offsets any losses from your traditional trading. So, in this case where this particular trade broke even, the rest of our trades wound up producing big time. Right now, if the rest of your trades are going against you, this would have been a perfect time to hedge this. So keeping this trade in mind and keeping your eye, every evening I check in on the VIX. You should too. But right now you missed the boat, and you just wait for this to reload.
Yeah, and I remember the past couple of weeks we had a couple questions on, hey, what's going on with the VIX? People were eager for the pop, and I think the message was, hey, just wait. We're not going to become more confident. We can only become more worrisome. And so I like the analogy of reloading, and we'll continue to revisit it. The next couple of weeks should be a little bit more turbulent than most, just simply because of the political landscape. So, yeah, we'll keep an eye on the VIX. So thank you for that, Sarah. Moving
It's
on to
interesting. Speaking of the political landscape, I really feel like so far the market is just considering all this political stuff like a nothing burger, but I don't expect that to last long. I expect as we get closer and closer to the US election in November that we'll start to see rumblings in the market. But so far the market is quite muted with respect to all the shenanigans that have been happening in the political world.
Yeah, and it's definitely more shuffling than I think anyone expected. So we'll keep an eye on it. But moving on to our second name, which is another high-flying name that a lot of people are looking at, and that this is Baron from Reno, Nevada, interested in NVIDIA, which is actually cheap enough to trade these days. So what's the scoop with NVIDIA?
So, okay, NVIDIA had their, what was it, a 10-to-1 split? It's right here. Yeah, 10-to-1 split. So their price is now down. But NVIDIA has been suffering the same thing as Google, just not to the degree. Google really took it in the teeth. But NVIDIA, people are now, they were all jumping in on the AI boom, and now they're realizing that it's more of a marathon than a sprint. So you're seeing some money exit from NVIDIA. And I bet you're wondering, Baron, if now's the time to buy. And so, one of the things you want to think about is go back to your basics around swing trading, right? So if I pull up my, I'm going to pull up my studies on swing trading, right? When you're swing trading, what I usually like to do is I like to have a combination of a leading and a lagging indicator to tell me when it makes sense to get into a stock like NVIDIA. And I like to also make sure, because swing trading is based on the fact that there has been a strong trend. And then from that strong trend, you have a pullback. And then that pullback acts as a rubber band. And the more you pull it back, the more it's going to shoot you up. And so you just have to wait for that time of maximum pullback. But there's another thing. You have to make sure that the pullback isn't so strong that the rubber band has broken, right? And so that's why we look at the trend. You can see on this particular chart, I'm evaluating trend on a 30-day simple moving average. And you can see that my magenta line here, this 30-day simple moving average, is flat. If this 30-day simple moving average starts to pull down, it basically means that your rubber band has broken and maybe you shouldn't try to trade this as a swing trade. So we may see a bigger correction on NVIDIA than we thought. But if you own NVIDIA, I'm not suggesting that you sell, because I think that that's a long-term play. But we may be seeing a bigger correction. That tells me, Baron, that it's not the right time to buy yet. Let's assume that that rubber band hasn't broken yet, that we stay flat with our 30-day and then it starts to go back up. The next thing I want to see is that rubber band pulls back. So I'm going to use something like the Williams %R, or I could use some slow stochastics. I could even use the Bollinger Bands. I want to see that we've gone to an extremely oversold condition. So you can see that for most part in the last 6 months, NVIDIA has been overbought, meaning that the price has been higher than expected and it's caused the price to continue to go up, right? That's what overbought, the definition of overbought. And you can see that if you were to put a halfway mark on this Williams %R line, for the last 6 months, it's been above that line. Whenever the Williams %R is above that line, or any of those type of overbought, oversold indicators are above their halfway line, it means that price is going up. But what we look for is the rare circumstances where you dip not only below the line, but almost all the way to the bottom, right? And so you can see here that the NVIDIA has become extremely oversold, but that's still not a reason to buy in. Just because something's oversold doesn't mean it's time to start buying. That's why this is called a leading indicator versus a lagging indicator. This just tells us that it's ripe to start buying. The signal we actually want to use for is it time to start buying is some sort of lagging indicator. We want to make sure that some of the big money out there has decided it's safe enough to start buying, and they start buying. And once we get that inkling that they're in there buying, we want to ride on their coattails. We don't want to try to be a pioneer in this space, because if the big money turns against us, you're going to be quickly parted from your money. So I'm waiting, right? In this case, with my template here, I'm using, I already said, a 30-day simple moving average to evaluate trend, the Williams %R to evaluate whether or not we're overbought, oversold. And then I'm using a simple crossing of closing price and the 7-day simple moving average. That's this light blue line. We've talked about in the past how to hack your MACD indicator to make it easier to see when that crossing occurs. If I zoom in on this MACD indicator down here, it's basically the same thing as these closing prices in this blue line up here, but easier to see. So when this blue line crosses above this 0 line, that'll be an end of day signal for me to start looking to trade it those subsequent days and get into NVIDIA. That would be your signal. But right now, it would be premature, and I feel like there's too much uncertainty in what's going to happen next with NVIDIA for you to start buying. It's not at its low yet. Wait until you can start seeing the accumulation taking place. Then jump on the coattails of those people driving price higher.
And I know that on the Tesla call, they mentioned NVIDIA a little bit, which I think did have a bit of an impact on just the movement this week. So something that you might want to go back and look into.
Review.
Yeah. All right. Thanks for that, Baron. Moving on to our third and final name of the week. And this is Kyle from Houston, Texas, interested in Foot Locker, ticker symbol FL, which sounds like it should be a high flyer, but it's a pretty boring retail company.
I love boring retail companies. I love stocks that, look, Foot Locker, they don't give dividends. You know, I would love it if they gave dividends, because when I think of the investor and who's driving the price up or down, if the company gives that investor dividends, he'll be happy. And, you know, as a pig in mud, he'll be happy just keeping the stock in its range. Listen, let me zoom out a little bit here. I'm curious how long Foot Locker has been trading sideways like this. I mean, it's had some ups and downs, but pretty much for the last 8 months, maybe even longer than that, it has been in this range between about $20 and $30. Recently, it's more like $22 up to about $28. You know, Kyle, I think we've got ourselves a potential premium trade here. Let me go back to my other indicators that are good for sideways channeling. Let me just play around here for a second. Give me a second. I'm going to rejigger my chart. So what I'm pulling up, folks, is my fast MACD indicator. This one is just tried and true for identifying tops and bottoms in a sideways channeling symbol. And yeah, take a look at that. You got clear blue, which in hindsight, it's called back testing. We can see that there is clear signals at the bottom, clear purple signals at the top. You know what? I love it. And we're coming up. I'm going to wait for my purple arrow. Purple arrow, my indicators are end of day indicators. So, and it's all around how I like to trade, right? I've got a toddler who's almost to the point where she's growing out of the toddler stage, but she's still under 3 years old. So I like to spend my days playing with her. And then once she's gone to bed around 10 p.m. at night is when I sit down and I look for these end of day signals. And if I find any of these signals, I'll program a trading bot to look the next day for follow through. And if it finds follow through, it places the trade. If it doesn't, when I check in at 10 p.m. the next day, I'll find out whether or not I made that trade or not. And I'll either reload that bot or I'll decide I don't want to pursue that anymore. Or if I make the trade, then great. Now I'm going to look for the next step. So with that said, I'll wait for my end of day magenta arrow. Once I see it, that tells me that there's a potential top. I'll program my bot to look for follow through on the subsequent trading days. If I get that bot, what are we going to do? We're either going to short some Foot Locker. Let's look at the option chain. I didn't even pay attention to the option chain. I would short something that's around 8 months out. So I see a February option. I see a March option. And I'm looking at the bid-ask spread. The bid-ask spread is small enough that I think that there's enough trading that we could do something. The increment is every $2.50. So that means we could short ourselves at $30. We could short ourselves at $27.50. $27.50 is probably where I would aim. So I would go far out in time. I'm talking probably that March option. I would go deep in the money. Let me see if I can give you an idea of how deep I would go. We'll come over here to our option chain again. We're talking about the put option. You know what? I like this $40 strike price. So I'm talking about the March 2025 option, $40 strike price. It's trading at about 14 bucks. I can either buy these put options or I can short the stock. If I short the stock, I'm shorting it at $26. If I buy the put, I'm only spending $14. It's about half the price. So if you want to incorporate leverage, you might do that with that back month deep in the money put option. I would do that at the top, and that totally sets you up, dude, so that you could start selling put premium every time you get a light blue arrow. Start getting that cash flow in. And then like my program participant that we talked about with my during the key segment this week, if it starts to dip down below $22, if it goes to $20 or lower, you may decide to just stop premium selling altogether. The pattern has changed, and you'll just buy to close your short, or you're selling those put options, take your money and run and go on to something else. So I've totally just planned out your whole trade for you, but the first step is getting that initial covering position, looking for that top, and either shorting the stock or buying that put option deep in the money far out in time.
All right. Foot Locker. We've got some options. Once again, the link to...
I like what you did there with the word options.
The link to AJ's indicator is in the chat. It's also down in the scroll bar if you want to head on over there and pick that up. It's free, completely free. Once you sign up, you'll get some information on how to access some of AJ's other programs. So keep an eye out on that. And wrapping things up, AJ, heading into, next week is going to be August. Looks like you pulled up your S&P pullback. You want to touch on that real quick before we wrap things up?
I absolutely do. Listen, we like to do, when we're looking at the broad market, we really like to analyze what the heck is happening using a retracement kind of analysis. And I have to say that yesterday's close, so you see my number here, $5,400.40. Yesterday's close on the S&P 500 was $5,399.22. So it was about 80 cents lower than my threshold here. No great shakes, but we closed in this red section that I have here. This red section basically says we're in for some sideways channeling moving forward. We're done with the whole swing trading, which is why I kind of told Baron from Reno with his NVIDIA trade to just make sure that NVIDIA still has a trend before you do any sort of swing trading. My prognostication here is that we're in for some sideways channeling. And I've been talking about this for a while, right? I talked about how the last time we got a retracement, we didn't retrace enough. And so what that means is that your typical traders, your hedge fund, your mutual fund, your pension fund traders, those folks who they play by a different set of rules, a more predictable set of rules, they didn't get a chance to reload their buying guns, right? And yet we had this run up in price. And so what that meant, and this correlates with what we said earlier, Sip, that the lot of money was flowing into a few names. And so where the frick was that money coming from? It wasn't our usual predictable traders that moved the market. We were seeing money coming in from people who were watching the headlines around AI. We were seeing money coming out of an even other riskier class. We were seeing money coming out of crypto and going into AI. We were seeing people take their money out of their mattresses and out of their jars in the backyard and putting it into AI. That money, we were talking about how the bear jumps out the window. That money is even more volatile than when you have hedge fund traders decide to make, shorting trades or sell their positions. That money comes and goes like a fickle girlfriend, right? Or fickle significant other who will leave you, drop you on a dime the minute you're no longer any fun. Well, that's what we're seeing here. And we saw that once before. I have to point this out. We saw this once before. If I look at a year-long chart, this pattern totally repeated itself. We saw this run up, and then from December 28th to January 4th, we didn't pull back enough for these people who ran up to run it up further. So instead, we got this additional run up, and sure enough, once we hit the peak there, we had a very aggressive sell-off that created a temporary trend change. And then all of a sudden, we had to reload those guns and a lot of money shook out. It did it just exactly like it did about 6 months ago. But this time, it's getting to the point. In fact, looking at this year-long chart, those folks who have done any studies of Elliott waves, and I'm not usually a fan of, the market is magic and it follows these magical numbers. But anybody who is using Elliott waves is totally like peeing their pants in joy right now, because this is like a textbook Elliott wave picture. And if you're a student of Elliott waves, you know that the next couple of moves are down moves. I foresee that for the rest of 2024 and maybe into 2025, we're going to be seeing some corrections. And so I've been forecasting that. I'm glad it's finally paying out so that I don't look like I have mud on my face as much as I have. But with that said, you better get on the boat with premium selling, because it looks like the premium sellers are going to be in the pole position for the next few months versus, your trend traders.
And that volatility is exactly what we want to see and what we'll be forecasting the next couple of weeks, whether it's the presidential election, more earnings, the turning of the tide. It should be a very exciting remaining year, specifically since we have had such a run up in this first half of the year. We'll see if we can continue or what happens with the Fed and whatnot, but a lot to look forward to in the next couple of weeks. And so we hope that you tune in and join us. So if you've enjoyed the broadcast, we would gladly appreciate if you hit that like, hit that follow, hit that subscribe button so that we can continue to bring you awesome content on a weekly basis, on a daily basis. If you're interested in AJ's indicator, the link to that is in the chat. If you're interested in getting into his daily workshop. The link to that is also in the chat. We've also run through a few names. And with that, AJ, next week, we're going to be keeping an eye on the Fed rhetoric, right? More earnings and business as usual. Yeah.
Yeah. The Fed, pretty much predictable in what they're going to be doing, but it's what they're going to be saying that'll be key.
All right. Well, thank you for your time. Thank you, everybody, for tuning in. We'll catch you guys next week.
Bye, everybody.
For tuning into the AJ Brown Show. If you're interested in learning more about AJ and his investing techniques, head on over to tradingtrainer.com and create your free account today. And if you're not already a subscriber to the show, hit that subscribe button and we'll get you fresh content daily.